Today on the CEO Barbecue, we're looking at a large copper development asset in Argentina together with Aldebaran Resources. For a bullet point summary of this and all other CEO interviews, please go to resourcetalks.com and subscribe to our free weekly newsletter. The company you're about to hear from has paid us for the production of this interview, but this interview is still intended only for experienced speculators because this is venture capital and mining is a very risky industry where failure is the norm. All conversations are general and impersonal in nature, and they contain forward-looking statements. I'm not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital is at risk, and also visit setterplus.ca where you'll find the company's official filings. If you're not 100% sure you understand all the biases and the disclaimers that I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said herein. That all said, this is not Aldebaran's first time on the barbecue, so I'll save you the long intro here, and instead I'll link all the previous interviews in the description of this video, so please watch them if you haven't yet, unless you like missing out on some good barbecue. In a nutshell, though, the story of Aldebaran is one of copper, and specifically copper in Argentina, and even more specifically, a whole lot of copper in Argentina, but also a little bit of gold too, actually. They have an 80% interest in the Altar project in the San Juan province in Argentina. Altar is part of a tier 1 porphyry cluster that also includes El Pachon, Los Palambres, and Los Azules. Why John's back on the barbecue today is because they've recently published a PEA proposing a combined open pit and underground block caving operation for an LOM of 48 years. That's not a typo. It's a 48-year life of mine asset. The after-tax NPV 8 years shows a roughly $2 billion asset, a just over 20% IRR, and a 4-year payback of an initial $1.6 billion CAPEX, with C1 cash costs of about $1.70 per pound of copper equivalent, and an AISC of $2.25 per pound in the first 20 years. And that's actually an important note. First 20 years. In general, NPV calculations don't really do justice to long LOM assets. So year 21 to year 48 here is severely being discounted, if not really adding much to the NPV at all. All of this was also calculated at an assumed $435 copper, $2,500 gold, and $27 silver. Now, a lot of numbers in there, but essentially the PEA suggesting starting off with an open pit mine for 9 years, which would then fund development of 3 underground caving areas at Altar East, United, and Central, accessed by twin 3-kilometer declines. The output of the mine would be a copper concentrate, a high-grade copper concentrate really of 26%, with arsenic values modeled at between 0.5 and up to 2.2%, resulting in approximate penalties of just above 70 cents per pound. Aldebaran also looked at using the Nuton sulfide leaching technology on the same size of operation, so 60,000 TPD, by the way, which resulted in a lower NPV but higher LOM FCF. So we'll talk about all that throughout the conversation here. And now it's time for the company to move on to PFS work, essentially. And there are 4 rigs they're mobilizing for infill, geotech, and hydrogeological drilling, while also doing some ABA testing and environmental monitoring on top of water well and pump testing, while also applying for Argentina's RIGI tax framework, which, again, John and I discussed last time he was on the barbecue, but I'll make sure to ask more about it again in this one. Wally circuits, filter tailings, on-site concentrate processing, and potential hybrid concentrate plus Nuton setups type of thing may be doable here, but more about that later on in the conversation as well. And also, of course, risks, challenges, political situation, cost realism, community relations, and more of that in the conversation as well. And Aldebaran is listed as ALDE on the TSXV. And before all of that, before we get into all that, as always, I would like to remind you to be cautious because your capital may be at risk. So please go to setterplus.ca and wait for the full NI 4311 to be filed on there, and also look at the company's official filings and do further due diligence. Enough rambling for now, though. It is finally time for me to shut up and John, let you do the talking. But first of all, thank you for being here again.
Well, great. Thanks, Antonio. I like this format. It provides us a little bit more time to dive more deeply. And I think you just gave a great summary of everything I was going to say. So I don't know where we go to now. You captured it well.
That's the interview. Well, then we both get you get a morning off. I get an evening off. I mean that would be fun. But no, there is a lot to talk about. Thank you for the kind words, of course, off the bat there. We do have a lot to talk about, so I'll waste no time on pleasantries. When you first spun out Aldebaran from Regulus in 2018, John, so 7 years ago, almost to the date, actually,
Mhm.
is this the asset you had expected or hoped for, or do you think it could have been better, or had you expected worse? Yeah, what are your thoughts?
I think it's certainly met expectations, and it also the change in Argentina is what has just really uncapped this. I think we knew this would be a really big porphyry copper system. We weren't entirely certain on what the approach. Our strategy is to define the full system, see the size of the system, and then begin to de-risk it. So this PEA that just came out is the first step, visible step in this de-risking process as we go forward. And we always learn a lot in that process on what's the best pathway forward, how you can approach the project best, what are the market conditions. A lot of things are breaking in our favor right now, both in Argentina and in the copper market in general. So that certainly helped it. So what we focus on is delivering a project that will be of interest to major companies and provide the opportunity for a, if you will, an early monetization for our shareholders to realize a return on the investment they've made on this. So I think everything's lining up quite well on and as we're moving forward. We couldn't be more pleased with the project.
There are a couple of important things that I want to nitpick on in that last part of your
Mhm.
answer, some of the details there in a minute, but just maybe to set the stage, the way Altar is set up now from an economic perspective, is it already transactable? Like, is it economic and advanced enough for a potential operator to come in and build it, or does it need more of that de-risking that you're talking about?
That's a great question, one we get answered a lot. And it's not a simple formula like you get to this point, you know it's ready, and then you put a for sale sign up for it. It's much more complex than that. What we need is an environment where the major companies are interested in acquiring assets to put into production. I think we're on the cusp of that. We haven't seen very many acquisitions of development stage projects yet. Filo was the most notable one that's happened, but we haven't seen a whole series of those happen yet. I think we will see that quite soon and moving forward but we're not quite there yet. And you'd ask, why doesn't a major company pick up a project? Once we've demonstrated there's an economic pathway forward on the project that's quite attractive, why don't the companies swoop in and pick us off right now, ourselves or other peers that are in the same situation? And in many cases, the companies are actually more comfortable allowing us to continue to de-risk the project, knowing that we're adding value to the project and they will probably need to pay more. But each company has their tipping point where they're comfortable that it's been de-risked enough that it's a safe bet for them, but it's still a good opportunity for them to acquire the project to move forward. So strangely enough, in our business and the way this works is it's oftentimes they allow us to add value to the projects before they acquire them. But it's a safer bet for them to acquire. This project's a great example. This project was acquired in 2011 for $487 million.
Mhm.
A project that was not particularly de-risked and was in a country where it was almost impossible to make a large foreign capital investment and develop a mine. So that purchase was premature at that time. It really, they should have waited until there was a better, more clarity on the project going forward. I think that's a lot of what we're adding to the project right now. And I think we're moving back into a robust period when people will be acquiring these. But so we generally view that the sweet spot is approximately pre-feasibility stage. Up to that point, what we're doing is the PEA, we're showing a good pathway to go forward of several. And I'm sure we'll get into the discussions of the alternative scenarios that you could move the project forward with. Going to pre-fees, we start to really lock down the numbers on that and become much more specific. Now we're saying there's sufficient water in the area, but we haven't demonstrated the exact amounts of water that are necessary or exactly where it comes from. That's part of the pre-feasibility.
Hmm.
So there are details like that that would be best put in place before a company's comfortable that it's sufficiently de-risked to acquire it from us. And we want to be able to do that. It's not, our objective is not simply to sell the project, it's to sell the project well. So as long as we're adding value for our shareholders to this, we'd love to go a little bit deeper into it ourselves. But you never know if a group decides that we fit their strategy and it's time for them to move forward and make that first step. Or we'd welcome for someone to start the dance on that. But I don't sense we're at the stage where we've finished our job on adding additional value to the project.
What do they say? PEA is what an asset could be, and a PFS is what it would be, and then an FS is what it will be, or something like that. I think that's kind of
That's a good
saying
summary. Yep.
yeah. But hypothetically, though, and forward-looking, speculative, and all that, but what do projects like this at the PA or the PFS stage sell for on an MPV basis? Like, and what's kind of that difference there? Like, if you sold it now, would it be, I don't know, would it be a zero point 0.5 MPV? And if you sold it at a PFS, would it then be a 0.6? What is that? What's that balance there?
We can show averages for when projects are purchased at different stages. Prior to having the PEA, we dealt in the valuation per pound of copper in the ground. It's a very rough metric, but it somewhat works, and you can see a steady progression from mineral resource definition stage to a PEA stage to a pre-feas to a fees, that you consistently go up in the average paid for the project. The nice thing about having a PEA now is that you're actually wrapping economic parameters around it, because clearly you could have a monster deposit that's not economically viable. So the valuation per pound in the ground doesn't always work on that as well as you would think it would. But with a PEA in hand, you can see a wide variety of metrics on this. If your NPV is solid and people are comfortable with your NPV on it, in theory, they can pay up to your NPV and still have it be a positive transaction for them. But they always want to leave a little bit of room on there. So you'll commonly see about, 0.5 of NPV is a reasonable valuation for a project, which, interestingly enough, is not terribly different than what the valuation for the Rio Tinto agreement is for us on the project moving forward as well. So,
Yeah.
so a number of these things kind of fall in. What we want to do is refine the approach to as we go to pre-fees and take a number of steps where we think we can add to that NPV moving forward. And then you also hit on a really key thing, is there's the NPV really only captures the first 20 or maximum 25 years of your mine life. That whole back end of your mine is something that can add quite a bit more value. And you also have to be aware of the sensitivities. We've used a price reference, a price deck on this. That's what most groups would use for their evaluations of projects right now. But if you take a look at actual prices today, and we point this out in the press release, that NPV goes from 2 to 3.3 rather quickly on there. And so companies are aware of that upside. They're betting on that upside oftentimes as well. So, and in the copper space, I'm quite comfortable that betting on that upside is pretty wise. I'm not sure in the gold space how aggressively I would chase the high prices we have right now.
I think you have me to blame, or people like me. I'm an accountant, though not a very good one, but by training, I'm an accountant, and we don't really get mining, and we like, sticking a DCF on everything. And
Yep.
and that doesn't work for assets that would go on for 50 and potentially more years. I mean, most of these assets that initially were targeted as, long life assets that are 30 years or whatever, they've been going on for 75 and so on. And in my defense, I suppose it is hard to put, a real today's value on it, on what's going to happen in 100 years from now. So that's really where that comes from.
There's another interesting thought to that too, as well as is that you can also take a project. This is a classic project where you could take this project and really ramp up your production and try to pull all of that forward into the time frame where discount cash flow evaluation gives you value on it. But when you do that, you're dramatically increasing your CAPEX to start the project, and that limits the number of groups that might be attracted to the project. And you also make it much more difficult to put a project in and permit it. And even there's some RIGI considerations that we had in terms of trying to keep that initial capital down. And I'm sure we'll discuss a little bit more our strategy on that and why our initial capital came in a little bit lower than perhaps some people thought, but why we feel that's a very defensible number.
I thought it would be over $2 billion, just off the bat. And I do have questions about that, and I want to go on to the details here in a minute. But what else do you have to do then in that case? I mean, what more de-risking would the asset need before the value of the potential sale is optimized, as you say? And then I suppose really what I'm asking here, more importantly, is how much money, how much time would you need before you can get it to a transactable point?
Well, we're projecting that we'll have the pre-feasibility study done by the end of next year, which is a pretty aggressive time frame. When you move from a PEA to a pre-feasibility study on a really big porphyry like this, one of the big issues to tackle on this is at a PEA level, we're allowed to use measured, indicated, and inferred resources to prepare a PEA. But when you prepare a pre-feasibility study, you can only use indicated and measured resources. And so oftentimes, if let's say you have a large deposit that's predominantly inferred, to move all of that mineralization to a higher degree of confidence on a resource categorization, it requires a lot of drilling and a lot of expenditure to do. But we're quite fortunate on this project. The fact that there was a lot of drilling already there when we acquired the project, and then we've put quite a bit more in over the past few years, is that 80% of the resources that were included in the PEA are already at indicated and measured level. So we don't have that much material to convert. So this program we're starting out, we're already drilling now to get those additional inferred resources to the higher degree of confidence that's required. But we're fortunate that we don't have a lot of that drilling. So that both shortens our time frame and also drops the cost that we have to put into this. I think a more normal time between a PEA and a pre-feas might be 2 years, and we're planning on doing it in just over a year from now. So that's an important point to note on the project. But a lot of the other activities that we'll be doing now really move into collecting the type of information you need to know to more accurately project what a project will cost and what it'll return for you. And so these are things like geotechnical drilling to determine slope angles. We'd like to optimize that. We've used standard assumptions now based on the data we have, but we need much more specific data. A lot of water drilling to determine how much water we can take out of the pit when we dewater the pit, and then how much remaining water we need to acquire from other sources and where those sources will be. Condemnation drilling, a lot of studies on how we manage the different products from the mine. So acid balance studies to determine how we safely store tailings, material like that. Surface land acquisition, the RIGI application is a very important part of the de-risking process on this. With a approved RIGI application in hand, that locks in the current very attractive tax incentives or incentives to construct a large mine, and that would be very critical for us to obtain. So all of those are the type activities that we'll be doing over the next 14 months. We've got quite a bit of work to do here.
And that opens quite a few questions for me as well that we'll get into here in a minute. CAPEX first, though, promised to ask about that as well. Yep. How is it not $2 billion or more?
What we did is we took a very staged approach on it. So you'll notice that our initial CAPEX is about $1.6 billion, but our life of mine CAPEX, our total CAPEX is about 5.6, which is more consistent with what I think people would anticipate for a big project like this. Keep in mind, we're also, by the way we've designed this with the pit going after a higher grade zone we have near the surface and then going underground to get better grades on this, we're operating at a 60,000 ton per day. Not the 100 or 120 that people may have anticipated. So that lowered a lot of our costs. And then a real important part of our approach on this is we're staging our CAPEX. And so rather than build a monster tailings dam right up front, for 40 years of tailings. We've feathered that CAPEX in over the life of the mine. So we build the first lift to cover the first 3 or 4 years, and then we put capital farther out. So our sustaining capital is higher, but our initial CAPEX is lower, and that allows you to get a better return on the project. And in many ways, that's the level of detail that you go into more at a pre-feasibility stage. So we kind of joke with SRK, who prepared the study for us, that this is almost a PEA plus on it because we've gone into much more detail on how we're doing it. Other activities on this, by going underground with an open pit first, you don't have to bear the underground development cost as initial CAPEX. That's sustaining CAPEX that comes in and is partially funded or funded from the cash flow from your open pit. And so it is a high CAPEX project. It's just we've moved a lot of that out in the years into sustaining category rather than initial upfront CAPEX, and that helps improve the economics on the project.
How final are those CapEx numbers in total? Like, I mean, would you expect it to be much different for the PFS?
In general, when you're doing a PEA, you'll commonly see plus or minus 30%, or some people will state plus 50, minus 30 on this. And then there are rules of thumb that each group that prepares these works on as you try to reduce that value. So, but having said that, one of the things that we worked with SRK on this is that we tend to compare ourselves to peers a lot. It's kind of natural, and I think many of our investors do as well. We look at the basket of companies that have assets similar to us that might be available, competition, if you will, on this. And so a lot of times we'll look at a recent study put out by one of our peers, a PEA or pre-feasibility study, and the price assumptions they've made in there, and we kind of compare to that. SRK wasn't that comfortable doing that. And their reason on that is that their lots changed rapidly. We noticed the price increase is one of the things that's changed for metals, but the cost to build a mine and operate a mine is increased almost at the same rate as the price has increased on this in many ways. And so they pointed out that most pre-development stage studies that are, say, older than a year from now are not particularly valid and not good benchmarks for us. And so they made a big point of benchmarking against existing operations more than on paper studies. And that resulted in us having higher costs than we thought we would for mining costs and processing costs, but it's the reality of the business now. And it's partly why we see people being a little hesitant to build mines right now. Everyone realizes there's a looming shortage, that we have to get new mines in to be able to meet that shortage going forward. That almost undoubtedly prices will continue, that there still seems to be a hesitancy in the industry to pull the trigger to build new mines, even though everybody knows we should and need to do that. And part of that is because everybody's nervous about cost inflation on this going forward, and it's a hard estimate. So at this stage, we've done our best to get accurate estimates on this. I think we're more accurate on this project than we normally would be at this stage. But it is a preliminary economic assessment. It's just that. So there's a lot to fine tune on that as we move towards pre-feasibility. And as we fine tune those costs, they could go up, they could go down, but we will also be exploring additional ways that we can add value to the project, either by changing the rate of production or a hybrid approach that might involve both leaching and concentration on it, or moly circuits to go in. We haven't attributed any value to the moly in the project right now at all. So there are a number of additions that we think can improve it, but we will have to watch for those costs on that. But we're very conscious that when big companies take a look at this, they'll oftentimes almost automatically think of a higher number for their capital because that's their experience as they build. And as they dig into ours, I think we can defend our numbers pretty well, and we'll get a lot of feedback. There are a lot of groups that are watching us pretty closely, and I'm sure they'll provide us with a lot of feedback on our approach and how we've done it.
Yeah, and I want to talk about the moly here as well as the hybrid stuff but to your point, I mean, look at what's happening at or happened at Quebrada Blanca
Mhm.
DOS, I guess you would say here, where CapEx has continued to climb, timelines are slowing down, and how recognizable or comparable is that for you? And again, understanding jurisdiction differences and stuff like that might apply with San Juan and everything. But yeah, how
That's the experience a lot of big companies are having. One thing that we note is the mega projects, and QB2 would definitely fall into that category. Those ones actually appear to have more risk than something that's right-sized, is one way we would refer to this project. When you have a smaller project, you're not planning on a 1 kilometer deep pit immediately or things like that. Those ones, it's a little easier to estimate your costs and a little safer to estimate your costs on it. And that was a consideration for us as well on this. If we took this up to a 200,000 ton per day operation to try to get as much copper as we could out in the next 20 years on it, that would look wonderful in terms of the amount of copper produced. It would be much more risky of a proposal on how you go forward, and a lot more debate on what your true costs and what the limits of how you can do and how fast you can build things and stuff like that. And we felt that would perhaps jeopardize the attractiveness of the project and do it. For some groups, that would be the approach they'll take, is to make it much bigger, much more quickly. But not all groups would do that. So we chose the rate that we've put on here and the approach we've done, partly because we feel it's a more confident project going forward than if we had blown it out really big.
Mhm. And again, size matters here, and you're going for that 60K TPD that you mentioned. Um, is CapEx the only decision that drove that it's not,
No,
120
it's
or
not simply CapEx. The things that we laid out is we wanted a long life operation, which was pretty easy to do on this project. We also used some metrics. 100,000 tons of copper or copper equivalent per year is a pretty important number for most major mining companies. So we didn't want to design something that had like a really high rate of return, but was less than that per year. So that was important. And then as we've been discussing, we wanted to kind of minimize that upfront CapEx by creative design that extends it over the life of the mine rather than having it all right up front. And we also wanted to minimize the operational footprint of the project. And a lot of the consideration there is that um, there are a lot of projects that are lined up with potential to be developed in Argentina right now, and particularly in San Juan. And we wanted to make something that could be permitted more easily. And so by keeping a smaller footprint on the project, still meeting key parameters to be of a size to be of interest to most major mining companies on this, we felt that would allow us to have something that we could more confidently move forward quickly. When we're looking at these big development stage copper projects, that's much more valuable. This mine or this deposit is much more valuable if it turns into a mine in this cycle in the next 5 to 10 years. If it for some reason becomes one that's harder to permit or a much larger investment, and the decision's not made, and a number of other projects come in and take up that supply gap there, then this one could get kicked off to the next 20 years, and that's value destructive for all of us.
Mhm.
And so we really wanted to design a project that could be permitted quickly and confidently with less risk and move forward to capture the opportunity that's looming right in front of us right now.
You're also going within the operation for 8 cube shovels and 100-ton trucks. Is that part of it too? Is that related to CapEx and permitting as well, or is that how did you right size that?
That was interesting. SRK has quite a bit of experience on this, and they propose this as a way that they think they can lower their mining costs on it moving forward. And it has to do with availability of fleets and flexibility of design within the pit. When you go really big trucks, it makes it a little bit awkward to do some things sometimes. And so they felt this was a sweet spot. That's the type of thing that will be evaluated in pre-feas as well going forward. We'll do trade-off studies on different size equipment, but this is where they felt was a sweet spot to maximize our NPV and IRR at the pathway we've chosen to go forward.
I thought it might have something to do with your kind of power and water sources and essentially.
Intuitively, maybe, but early for that right now.
Yeah.
So that's a lot of what we'll be doing over the next year in the pre-fees.
So that's something that I did want to talk about. So essentially, too early to talk about power and water now. Then.
No, not necessarily. It's worth pointing out that in terms of water, we'll view that there are two sources of water for the project. One is you put in the pit and the underground workings, you have to dewater the ground to be able to prepare it to be mined. So that produces water from the dewatering of the mine. And we have preliminary information on that. We have a lot of work to do in the next year to further quantify that. And then additional water would come from local sources. There's free flowing water year round on streams nearby. The water is there, but we have to quantify how much we need, and we need to present the case on why we can acquire the rights for that water to move forward. If we were the only mine going in San Juan, I wouldn't be concerned about it whatsoever at all. But we're one of several mines that are going in. And as mines are developed, more mines are developed in San Juan, we'll see an increase in population in San Juan. We'll see companies motivated to put in new wineries. I think the wine industry is really just starting to boom in San Juan right now, and that'll be more agriculture. So there'll be more demands for water than simply just the mine. So we need to put our project into context of all the other groups that need water going forward, and make sure that we're presenting something that doesn't restrict the viability of other activities in the province. And so that's part of why we want to move as quickly as we can on this, and perhaps have a footprint that's smaller and easier to permit and easier to demonstrate that we're providing more positive impacts than we're potentially creating problems for neighbors.
You've been to site in the last 6 months, I believe, and I asked you that last night. How much does a 10-ounce steak cost you in San Juan these days?
It roughly speaking, it's probably doubled from previous years. We had a number of years there where it was incredibly cheap to be able to dine out or do things like that in Argentina, and so those prices have increased, and it's an important point because. And why one of the reasons why the election recently was so important on this is that the steps that President Milei have taken to make it much more attractive for large foreign investments to build mines or oil and gas projects or lithium projects or big agricultural projects, the RIGI doesn't just apply to mining, have been very well received by foreign companies like ourselves that would like to produce a project that can be built in the country. It's just the steps that were necessary to make the mining industry take off. But a number of the steps that he's taken to make it more attractive for us to come in have resulted in more economic hardship on people living in Argentina. And so salaries have arguably gone down, cost of products have gone up. In exchange for that, inflation is largely gone now. And so that's helped a tremendous amount to have a stable economy, a stable price scenario on this. But it is more economically stressful on the average Argentinian citizen right now. And when these projects come in, though I'm very confident they'll produce the jobs and the other opportunities, service provision opportunities, and other things that will stimulate the economy going forward. But there's a lag. Right now, we're indicating what we want to do. We're applying for these big projects to go forward, but they're not really activated on the ground just yet. And so the cost for economic stability and the cost for creating an environment that will provide much more economic opportunity in the future is being borne by almost every Argentinian citizen in many ways. And we view that that's also important for us. I mean, those additional costs hit us on simple things like dining out, but it also affects our drilling costs. It affects a lot of our other costs on the project. So our costs are going up.
Mhm.
They're not terribly high compared to neighbors. They were actually quite low for some time there in many cases. So they're kind of moving up to prices that we would see in Chile or Peru or neighboring countries, which seems like a lot, but it's not terrible in the big picture on it. But we view it as it's part of our job too, is to bear those are the costs that we assume in order to have a much more attractive setting to be able to actually build a major mine.
Well, in their defense regarding the stake, though, if you quality adjust it, it's probably still much cheaper than most
Oh,
countries
absolutely.
in the rest of the world.
Absolutely. Yes.
You're
Mm.
teasing me. I've not been there, but I feel invited at this point. So maybe I'll bring change into that sometime soon, and then you bring me out for a steak.
You're welcome to come down. We'll get you down there sometime. So
John, once you have the concentrate here, you're modeling it at 26% copper with a 0.5% up to 2.2% arsenic in concentrate.
mhm.
Who takes that concentrate? And is it what does that even mean in the first place? Let's start there. 26% copper in concentrate, up to 2.2% arsenic. Is it an easily sellable product in the first place, given the nasties essentially here?
It is, and much more so now than it was, say, 10 years ago, when arsenic was much more of a concern. And we'll optimize that. There'll be a lot more metallurgical work that's done on here to optimize that con as we go forward. I think we're being a little conservative on some of the parameters we're assuming there. But the one you've keyed in on, the one real critical thing to look at are the deleterious elements, most importantly, the arsenic on that. So we've noticed on both of our companies, each of our companies have large copper projects, and both of them have some degree of arsenic to them. And what we've noticed is over the last decade that the comfort or the ability for companies to work with arsenic has improved dramatically. And that's partly because we're seeing the average arsenic concentrate of, or average arsenic grade of concentrates go up around the world. So smelters have had to begin to deal with it more. It's not as simple as you can just buy only clean con out there. And so they've taken steps to be able to process arsenic more efficiently and at lower costs. And then one of the things that we're noticing right now is they're within a concentrate in a smelter scenario, is that there's an abundance of concentrators around the world right now and smelters, and a shortage of con supply. And so one of the real notable things on this is when you send your concentrate to a smelter, you get hit on a couple charges. You get hit on a treatment charge, and then you get hit on a processing charge. And so the processing charge on this has actually gone to zero or negative in some cases, because concentrators and smelters are competing so much to get product right now. And so that creates a situation where they'll lower their costs. And we've seen that in arsenic. As part of this study, we commissioned CRU to provide us with an up-to-date evaluation of the concentrate market. And the treatment charges for arsenic going to a smelter are dropping just as the processing charges are as well. So that's good news in many ways on this. And then we're also seeing a lot more blending happening around the world. And the levels that we have are within the range of material that could be blended with cleaner con to lower those arsenic levels pretty easily. And we're also seeing a number of alternative processing options that get around the arsenic. And that's where, for example, the hypogene or primary sulfide leach technology of Nuton comes in. When you heap leach the primary sulfides, you break your sulfides and your sulfur salts down. You liberate your copper to be able to get to it. You also liberate your arsenic, but it's quickly seconded into a mineral called scorodite, which is a non-soluble mineral, and you trap your arsenic in a safe and non-soluble way into your pads. And that removes the arsenic issue altogether on it. It's one of the strong benefits of doing primary leaching. Some groups are also looking into pre-treatment. So you take your concentrate, and before sending it to a smelter, or even without sending it to a smelter, you treat your concentrates by perhaps pressure oxidation by putting them into a large autoclave or various other roasting techniques and things that you can do on this to be able to also sequester that arsenic in a much more manageable form than if you send it straight to a smelter. So those numbers we've in this study we've hit it pretty hard with those. You pointed out the treatment charges that we have on it. I think there is a lot of room for us to lower those as we fine tune things through pre-fees and beyond.
I suppose part of that could change if once you involve Nuton. Well, not part. A lot of that will change if you involve Nuton. How much more do you know about it now than you did last time we spoke?
Quite a bit more, actually. Not so much on the processing. There are new alternatives. There's a lot of competition in that primary leach space right now. There are new companies every day that are popping up with different ideas on that to go forward, which is good. That's what we want to see in that space. I think what we've learned more about is just how it actually works and what the supply and demand is for smelters and how much concentrate do they need to take and how companies are approaching that. So keep in mind that with both of our companies, we interact with most, if not all, of the major copper and gold miners. And so we hear a lot from them as well on what their comfort level is and what their approach. And each company has a different approach to it as well. So some companies, the gold recovery is really critical to them on it, and so they will focus on techniques that certainly capture the gold and capture as much of the gold as possible. So gold dominant companies tend to lean towards pressure oxidation and autoclaves and processing techniques like that, whereas the copper dominant companies might look more towards a heap leaching process that would recover the copper and forego the precious metals, but feel that they can make a better profit by going that way. And so each company has a different strategy, a different focus, and a different comfort level with different processing techniques. But we learn a lot from talking to all of them.
Well, with Nuton, there is a precious metals loss essentially. Is that something you'd be willing to see through in your case, or could it make more sense to look for again one of those technologies that you're talking about that extracts more of the gold and silver?
Yeah, good point on this. And just to help people understand this a little better, when we embarked on this, we were doing a full evaluation of the concentrator case and a full evaluation of the Nuton case. But the way it works in 43101 reporting is we have to pick one as our base case. And we chose to pick the milling and flotation and concentrator case as our base case because that technology is available to everyone. It's a good starting point on this. And then you can evaluate your other case and report it it'll be in chapter 24 of the 43101 that will come out shortly. And you can show what you've done on that, but you can't lay it out as a side-by-side alternative. And that's just the way 43101 works. They feel that they want their investors to look at a base case that is your case going forward, and then you can do what ifs on the others. We did a full evaluation, so the work behind Nuton is much more complete than it might appear in the press release or in the 43101 that comes out. We did a complete evaluation of it. But the way we have to report it is by showing variation, almost a sensitivity analysis of if we use the Nuton case, what would that look like versus the base case that we use going forward. And they're very competitive. They're very comparable going forward. Each has its plus or minus. As you point out, Nuton doesn't recover the gold, and they actually have a slightly lower recovery of the copper. But their operating costs are quite a bit lower as well. And so that results in a lower cash cost for the mine and a higher cash flow for the operation going forward. The capital costs came in quite similar. Technically, the Nuton in this evaluation was about 4% higher on the initial CAPEX, but much lower on the life of mine CAPEX. And that was just due to the way we had to treat it. You have to build your tank houses and everything for your heap leach up front, and you can't defer that capital through the life of the mine as much as we did. So that was a little bit of a surprise to us that we thought that the capital costs would be lower. It is in terms of overall capital cost. It's just it's slightly higher in the upfront costs. So I think right now, depending on your preference on this, the best way to approach this is that they're both perfectly viable options going forward. I think we've presented Nuton as certainly an attractive option for us to go forward on the project with. And there are things that we can do now to better evaluate Nuton moving forward. And there are also ways we can perhaps think about hybrid options where perhaps for certain material, we might want to mill and produce a concentrate. Our gold grades are not consistent throughout the deposit. We have sectors of the deposit that have notably higher gold to them, as we have sectors of the deposit that have notably higher moly as well. And so one of the things we'll do is a trade-off study of perhaps those areas with higher precious metals. Even if we were doing a primary leach technique for the bulk of the material to get the copper, we might want to choose things above a certain threshold and have a small concentrator case that approaches those. And so those are the type trade-offs we'll do of sort of kind of hybrid scenarios going forward as we move into the pre-feasibility study. So yeah, a lot to learn, a lot to go forward. But the main thing that we've demonstrated on this is that Nuton is a perfectly viable pathway forward on this. One of the other things about Nuton that's important is that there are a lot of sort of intangibles with Nuton that are hard to get into an evaluation like this, and those largely lead into kind of the ESG side of things and the permitting side of things moving forward. If we were to go with primary sulfide heap leach Nuton technology, we would utilize a lot less water on the project, which is an important consideration. We also have a lot more flexibility on the footprint. You're not as constrained on where you put some of your activities on it to move forward, and you produce copper cathode in country, which is a big value add. It's rather than exporting a concentrate, which is often viewed by countries as exporting value or exporting jobs when you do that. If you capture that copper cathode in country, that can allow for additional industries that further process that cathode in country, which creates more jobs and more value captured inside Argentina, which is attractive. And we've already mentioned the benefits of seconding or sequestering the arsenic and managing that in a much more valuable way. So a lot of those things don't necessarily show up directly in the economic evaluation, but certainly would be considerations you would have on how do you go forward on a project. So we're not intentionally trying to minimize the Nuton aspect of this. It's partly how we have to report it going forward.
It also, I guess, depends on the price assumptions that you're taking, right? Because what if gold goes to 5,000, copper stays here, or vice versa? What if copper goes to 10 and gold goes back to 3,000 or whatever? Then one of the other options might make more sense on paper, but it's just that price assumption that you're willing to take, and it comes down to the preferences of the buyer, I suppose. In that case, who do you think, just to the point of CAPEX, who do you think has the balance sheet essentially to and again in the hypothetical realm, who's got the balance sheet or a large enough balance sheet to actually build this asset as is in this setting, again accounting for infrastructure and politics and everything else? Who's got the balance sheet to build it?
I don't think I want to get into names on this because I will undoubtedly forget someone and leave them off the list as well on this. But at the size we've proposed going forward, we've intentionally opened this up to almost any major copper company. And one of the things you look at for the copper companies too on this, and this is a copper dominant project. It's unlike our project in Peru, which is almost equal parts precious metals and copper, and much more attractive to gold companies. This one, really the key audience would be most likely the copper companies or the multi-commodity companies. I wouldn't exclude a gold company, but there is not that much gold in this proportionally on the value to be of interest to them. But when you look at the copper companies, Um, there are companies that are large copper companies that you would certainly have the balance sheet to be able to approach a project like this. But when you look closely, you might realize that they already have 3 or 4 development projects of their own on their books. And so we and some of our strategic advisors that help us with this process evaluate all the companies in terms of the likelihood of them being in the market to acquire a project. And so you can look at one that has the size and the balance sheet to do them, but you realize, boy, they can double their production just with projects they already have in hand. So why buy something? Um, there's a good way to look at these when someone buys a project from us. What they're really evaluating when they do that is a buy and a build. So they're thinking about the cost to buy it and the cost to build it. Whereas if they already have a comparable project of their own in hand, they just have to think about building it. They don't have to pay that cost. So we have to be better than projects they already have in hand. So we really target the companies that dramatically want to increase their copper production, but don't have internal projects to go forward. So they'll need to go out and acquire projects. And so there are plenty of those that are there, and you can see them already, even in our strategic partners that are on there. Part of the reason our strategic partners are helping us move this project forward is because they're very interested in acquiring new projects to build.
Where I was really going with this is essentially asking, does it have to be Rio? Is that
No,
more or
not
less
at
the
all.
only option?
No,
So that
not
yeah,
absolutely not at all. And keep in mind we focus on Rio right now because of the test work we're doing on this, but it's really important to acknowledge our other strategic partners right now. We have 80% of the project. Sibanye-Stillwater has 20% of the project, and they're funding their portion. They're maintaining their interest as we move the project forward. They're not a copper company per se. We'll see what they choose to do as they move forward. But we also have South 32 as an important equity shareholder in the company, and they've been very aggressive in Argentina. They were an early mover in Argentina, looking for new opportunities. And as many may know, that was a group that spun out of BHP with a lot of non-copper and non-iron assets to get set up. And so they're a decent sized company, a pretty good shaped company, but they're notably have a hole in copper production that they would like to fill. And so they're kind of a classic company that would be in the market. And it's not surprising that they're working with us on this project to provide them with a toehold in this in many ways, but we structure those agreements when they come in so that we're not wed exclusively to one strategic partner or another. Our job is to make this project attractive to as wide a range of potential suitors as possible. Those that are strategic partners for us certainly has some advantages to go forward, but we wouldn't we wouldn't lock anybody else out from it. And another important thing to note on this is that increasingly on these really big projects, at least in South America, if not around the world, we're seeing that it's not uncommon now to see 2 or even 3 companies go together to develop a project. Some of that comes through the history of the project. Some of it's quite intentional, actually, to share risk and help take on the large capital costs that are there. And you even see some scenarios, or could imagine some scenarios where, maybe a precious metal miner hooks up with a more base metal miner, and they each treat the same project in a different light in that way. So, or even help from, we're seeing increased interest from some of the Asian smelting companies. That used to be a common thing, and then they kind of backed off for a decade there or so. But now we're seeing those groups come back in and interested in taking minority positions, teamed up with a capable operator to go forward. So there are a lot of different possibilities on this, and we're certainly not excluding. We're intentionally trying to keep this as attractive as possible to as wide a range of potential suitors as possible.
you and I have talked about this in previous episodes as well. Like, is there room for another strategic and stuff like that? I think you've done
It's
a good job
probably a little,
explaining that.
you never say never. Scenarios come up and things are different, but I think we've got a pretty full dance card right now
Yeah.
in terms of investors on the book. You can go too far on it too. And And many of us had to, and to some extent, until this past year, it was not easy for us to raise money at the levels that were necessary to move a big project like this forward. And so many of us reached out to or responded to inquiries from strategic partners, and that's how a lot of us finance these projects moving forward during that period of time. Now it's much easier to raise capital in the open markets. It's changed dramatically in the last year, and so that I think any additional capital that might be necessary would probably be more of a traditional raise.
What is Rio indicating in terms of their interest in proceeding with the deal that would put you at 60% ownership, them at 20%, Sabani at 20% of the asset? Is it looking like that's still their plan or intention here?
I can't speak on their behalf right now, and even I honestly don't know their decision right now, and we'll find out quite shortly. We'll go through the time frame on that in a moment. So it'd be out of place for me to comment on that really. I think we've demonstrated quite a viable result for their techniques to go forward on the project and laid out a pretty good case for it. But we'll see what their decision is. The way this works is that we put out the PEA last Thursday. Normally we have 45 days to produce the 43-101, and in our space it's pretty common. It comes in about day 40, even if you think it's not gonna, if you could do it earlier. In this case, when we file the 43-101 report, that's the trigger for the review period or decision period for Rio Tinto Nuton. So they'll have 20 business days from the date that we file the report.
Mm-hmm.
So we're working hard on that. For their interest and our interest, and to stay on timeline for pre-feasibility, we'd like to have that decision as soon as possible. And so we're working pretty hard on the report right now. It'll be out very, very shortly. And then once that's out, they'll have that period of time to review everything and go through their own internal processes on what they need to do, and then notify us if they're making the next payment, which is a $30 million US payment to maintain their option. And reminding listeners that that's not an equity placement. That's simply an option cash payment to move forward.
Yeah.
They've been great partners with us, very, very, very helpful on the project, a really good communication with them going forward. We certainly value the relationship with them, and I think we've accomplished the goals that both of us have on moving forward on the project. So we'll find out shortly, certainly by the end of the year, late November, early December, we'll have that decision from them moving forward. We're not waiting for that to happen to begin to move aggressively on the project. We have a reasonable balance sheet right now, so we're already kicking off our field season as scheduled and as planned. Right now, we have 2 rigs already drilling and 2 more arriving shortly on the project, and we'll start with 4. We may have to increase that a little bit with some specialty rigs as we get later in the season, but we're planning on a full steam ahead project right now.
Not needing 30 million bucks is actually a good spot to be. I think I would have a different answer if someone asked me that question. But would you want them to proceed, John, now that you've seen the asset? I mean, really what I'm asking here is because at $250 million for the whole deal, essentially, which gives them that 20% asset level ownership, they're paying about a 0.62 NPV8 to be specific. So is that a good deal for Aldebaran shareholders, again, given that you don't necessarily need the money now to continue?
I think it's a great deal for us, and particularly considering that the portions of that we received up front on it. And so I think it's an outstanding deal for us, and I think it's a good deal for them. It allows them to maintain optionality on acquiring an interest in the project. When a lot of the agreements they have allow them to work with the company to test their technology, but they don't have a guaranteed pathway to acquire part of the project. And this allows them to do that. They're from what we understand with Rio Tinto is that they're not interested in developing Nuton simply as a technology that they say license out to companies in exchange for cash payments on it. It's not a money-making venture in that sense. They really view Nuton as a pathway for them to acquire what they refer to as attributable copper. And so they want to be able to use it to evaluate a project where they could acquire all the project, or they could acquire a portion of the project where they get actual copper that helps them. Keep in mind they're second largest mining company in the world, but they're they're at the lower end of the top 10 in terms of copper production. And so they, like BHP and like several other large companies, are heavily telegraphing that they want to increase their copper production going forward, and they don't always have a lot of opportunities in hand. So I think it's a very good agreement that's laid forward, and it's allowed us to move the project forward. And as I mentioned, we work very well together. They're fantastic in terms of communication with us on what we're doing, and I'm very intrigued on seeing that this type of technology will work to go forward, because I think it's a much more environmentally friendly way to process copper. We won't, as an industry, we won't do that just because it's a greener way to do it. It also has to be an economically viable way to go forward. And I think the study that we've put out shows it as a perfectly viable pathway to go forward, a very competitive alternative.
Well, and then to that point, I suppose what's left on the back end of your production, or what you're talking about right now, is also interesting. The tailings, essentially, you're talking about a TCF concept. Why now, and when would filter tailings trigger?
That's something we'll evaluate. We didn't feel that we had enough information to do that in this first pass, so we went with a kind of a more conventional. Filter tailings are interesting because I think we, in the industry, we all recognize that on operations that do produce conventional concentrator tailings, that we as an industry will be increasingly moving towards filter tailings. But it adds an additional cost to do that. It does have some benefits on better recovery of water and things like that, and a lot more flexibility on where you put your materials. But it's very similar to hypogene leach technology or other things that it's been demonstrated to work, but there aren't very many examples of really large scale filtered tailings projects yet. Mm-hmm. And so everybody's kind of watching how that envelope's pushed on it and where that goes. And so we felt if we jumped straight to incorporating filtered tailings into the PEA level, that might not be decreasing risk, because some people would view that as making an assumption that they may not be comfortable going to. So we went with a conventional approach, but it's certainly something that we'll evaluate as we move towards pre-feas.
I suppose politics are part of that too, and not only financials, and that might be worth touching upon here. Did you present the PEA with the, again, almost 50-year LOM and everything together to any government officials yet? And is there any more clarity on the permitting process that you might have to undergo?
Yeah, we interact. The great thing about San Juan is the Ministry of Mines and all levels of the provincial government are cheerleaders for us. They really would like to develop a mining industry going forward, and so we have very good access. We've sat down with the Minister of Mines on this. We've gone through with a number of the cabinet members on this. We happened to put these results out last Thursday, right when there was a major mining conference going on in Mendoza. So there was a lot of visibility on this, and we've gotten very, very positive feedback. And they're very, very collaborative with us. Very, very hopeful. This week they laid out their intentions on moving forward. The election that just happened is a clear signal that people are willing to give Milei more room to continue to make the changes that he needs to do, and he'll be in a better position with better support from Congress to be able to go forward with things. And so they are already kind of laying out their strategy. They feel they've accomplished the fundamental things that were necessary to provide a better environment to attract us to come in, and not just us. We were always there as explorationists, but to attract major mining companies to make the commitment to develop mines. But there are additional changes still that they would like to do going forward. And so they were pretty excitingly laying out what they're planning on doing right now. So the level of enthusiasm is very high, and the project was received very well at government levels and in the community levels as well. The communities are dying for new jobs and better paying jobs.
That's also a good point you're bringing up, because I've been thinking about kind of recent unfortunate happenings at different copper mines in the last couple of months, really. El Teniente is recently in Chile. Are you going to be required by government or community to conduct any additional tests, or, from, I don't know, seismic perspective or pillar integrity design, or anything really related to increased safety standards?
We haven't seen a response that way either, industry-wide or particularly specifically locally on this. That's a large part of what we have to do to go forward anyway. And kind of an interesting thing to point out, because we proposed the underground option on this, and that wasn't probably on a lot of people's bingo cards when we came out with that. We do believe it's economically the best way to go forward on the project at the scales we've chosen and pathway we've done on this. But there have been a couple notable incidents with underground mining worldwide. But there are also big slope failures and really big open pits as well. So I think sometimes when mines are getting really big or late in their mine life, you tend to hit new boundaries on things, and that was a consideration for us on keeping it at size and scale. There's a lot more experience. It's a lot easier to manage things going forward on the project and demonstrate that. So that was certainly consideration for us on it, but we're not seeing things, stringent requirements that would prohibit us from going forward with the pathway we're choosing, or making it so that you could only do heap leach and you couldn't do concentration or things. We're not seeing that at all. We're very much working within. We'll lay out the best alternative or alternatives to go forward on the project, and do those in the safest and most socially and environmentally friendly way possible going forward. So, and keep in mind the approach can be different for different companies. Some companies really focus on size overall. Some companies embrace underground. They feel they have an advantage that way. Other companies are more cautious about it if they don't particularly have experience in that. But we're seeing a lot of the projects worldwide now are increasingly moving towards either making a transition from an open pit into an underground operation, or evaluating just straight in as an underground option to go forward. So you take a look at like Los Helados from NGX, just across the Chilean border on the north end of San Juan. That's proposed would be an underground block cave mine. Undoubtedly, ATEX's Valeriano project would be underground as well. And so it's not that uncommon to see underground projects, and I think we'll see more of them moving forward.
John, let me know, by the way, if you have to go here, because you gave me an hour. I've already taken more than that. So you just let me know when and if you have to go. I do want to talk about RIGI, though, or RIGI. In the meantime, you said you know more about it now than you did 6 months ago, but it seems like not everything is entirely clear. What more can you tell me about it?
It's becoming much more clear. It's when the Malay government laid this out as an opportunity to attract investment. Even the government didn't really know exactly how it would work at that time. They put out some time frames that they were required to respond by, but then they had to develop the whole process of who would review it and how that would work. So they've learned how to review the proposals better. As an industry, we've learned how to prepare them better and present them better. There have been some cases where is a PEA too early to present them or not? And how does that work? And so a number of the cases in front of us have helped to resolve and work out the best pathway for this to work. Los Azules next door to us is a great example. They initially presented us a small RIGI application, a little over the minimum threshold of $200 million, because they were at a PA level and they didn't know exactly how it would be going forward. And there's some risk to having it approved that you have to begin to execute it immediately as well. And then by interacting with the government on that, it was decided that it would be better for them to present a more full RIGI on that going forward. And so they've presented that now and it's approved. and it's moved forward. And that was approved before they even put out their feasibility study results on it. So it's helping to clarify when projects are ready to present. And one of the key things that came out of that is that when it's obviously attractive for us to present a RIGI and have it approved, because that locks in a whole series of conditions that make it economically much more attractive to develop a mine going forward. But once they're approved, you're on the clock to begin to do the work. And the initial interpretation of that was you had to spend 20% of your approved amount within the first year and an additional 20% in the second year. So 40% of your RIGI approval within 2 years. For a group like us to submit a $3 billion RIGI application and then be on the hook for 40% of it in 2 years is a bit of a risk on there. And so now it's clarifying that initial commitment is a percentage of the minimum amount, not a percentage of the full amount of the project. So they're fine tuning this. It's in everybody's interest to make this accomplish the end objective, which is the establishment of a profitable mining industry that provides a lot of benefits to everybody. And so we're working more closely. So the more of these cases that are in front of us, the more clarity there is on the process and how to move forward. We've selected a group that has been instrumental in preparing successful applications by some of our peers, and they're working closely with us on a strategy. So the RIGI window is open until next July. President Milei can extend that period by 1 year, but we don't want to depend on that. So we'll prepare a RIGI application to submit well in front of that deadline based off of our PEA right now to make sure that we get that in with the best chance of having that locked in. If there is an extension, we'd prefer to go off of pre-feasibility. It'd be much more clear actual costs and everything, but it's more important that we get it in and get it done. So we've laid out a timeline on this, on both the preparation and the time to submit it to maximize the possibility to have approval of that. And it helps that we're not first on this, because the process has become more clear, and it's more workable now as it's moved forward.
First to be second, I suppose. And it's so you're essentially saying inside 6 months you're going to have a definitive answer on RIGI.
Inside 6 months, we'll know if we've applied. There's a process on how long it takes to do on that. But yeah, before we get to a pre-feas, we would have that. And that's an important part of the de-risking. If we're delivering a project that is RIGI eligible or RIGI approved on this, that's much more attractive to a potential acquirer. There'd be a tendency for us to say, hey, that's kind of the big boy stuff on this, and we'll leave that up to a buyer. But if we do that and the deadline is missed, then that destroys value on the project. So it's a very critical part of our value of our de-risking the project is to get that application in and approved.
To the point of the PFS being done by next year, by the end of next year, could you update QDM and radio and integrate new ounces into, new pounds or ounces into the PFS without kind of clouding the base case?
Yeah, good question. The radio's a great example. That's a very exciting project. It has some of the highest grades we have on the project, but it was clear that would be really only exploitable by underground mining on it. Just the geometry of where it sits, a very vertical body, and so we laid off that a little bit as we approach the main project. But now that we have a little more comfort on the parameters around bulk underground mining, that emerges as one. It's not necessary for the project. It's still kind of viewed as a satellite, and it would add additional optionality to the project going forward. But one of the considerations we have now, and this will probably depend on how much access to capital we have, is whether we bring that forward. And we'd only bring it forward if it adds value to the project. If it's adding another 5 years of mine life from year 50 to 55, then we probably don't need to spend the money on that right now. Yeah. So, but that decision will be made in the next couple of months here.
Okay. a quick summary, I suppose, here for me, John, and you correct me where I'm wrong or add where I'm missing. But the main questions here for you or for Aldebaran are RIGI status, Nuton status, CAPEX reality, resource conversion, and concentrate marketing. What else would you say Aldebaran's success is most dependent on right now?
All of those are pretty good list on there. The notable thing that you have missing there is continued interaction with local stakeholders, with communities, and communicating well the opportunities presented by this project and how that will work going forward. So that's an ongoing thing. It's going well, but as the project increases in size and importance and it becomes more likely that it'll become a mine, we naturally ramp up those efforts and make sure that everybody's comfortable with how we work and understands what we're doing.
Mm-hmm. Switching gears here a little bit in the sake of time, but you're also spinning out your Northern Argentina exploration assets in the meantime into what you're calling Centauri minerals. So you now I guess you'll be a single asset developer then in that case. One might speculate this is part of making Aldebaran takeover ready. What do you say? Why the spin out? Why now?
It came out for a number of reasons on this. We've held these assets for a long time. These were the original assets that we formed Antares Minerals, our first company, from. And then Antares pivoted to Peru to drill out and eventually sell the Hikira project. And we spun Regulus out of Antares and came back to Argentina, advanced the projects that are mostly in the north in Salta and Jujuy. And then, as luck would have it, a project in Peru, the Antiquary project, popped up, and Regulus pivoted back to being a dominantly Peru-focused company, and the project sat again. And then when the opportunity to acquire the 80% interest in Altar came up, the best way for us to do it was to spin the assets in Argentina out to form Aldebaran and use that as a vehicle to acquire the interest in Altar. So these projects have been with us for 20 years now in many cases. They're good projects. In most cases, they're a little bit earlier stage. They're a little different than what we typically target going forward. And when we formed Aldebaran and entered into the agreement to acquire the Altar project, our vision is that we'd be working on Altar 7 or 8 months of the year, and then in the off season for Altar, we'd go back up north and advance the projects in the north. And that was fully our intent when we started. But what we found is that Altar really took off on us. We were able to get much longer field seasons in on the project, and it became truly the flagship of the company, and we were putting all of our efforts into it. And we weren't advancing the projects in the north. And it's not because they didn't have merit, it's just that we didn't have time and resources to spread to those. And so we were being pestered by a large number of companies. Everybody wants to be in Argentina right now, and when you come in, you try to look for a project to get started. And they spotted projects that were interesting, that appeared to not be active, and started to pester us about perhaps optioning those off. And even the Salta government was trying to encourage us to move more quickly on projects because they get asked the same questions of interested parties. Why don't these projects become available? So when we sat down and evaluated that, we realized that our shareholders weren't receiving any value for that handful of projects whatsoever at all. And that wasn't really fair to our shareholders. And we realized that perhaps the best thing to do would be to spin those out. And we had the option to wait until if someone acquires the Altar project, that would be a natural time to spin those out. But we felt right now the market is just so ripe for new opportunities like this, and it would be good to get those moving quickly while there is a lot of interest in Argentina going forward. And so then we were faced with a conundrum of, if we spun out a new company for these assets, our management team is already running 2 companies with 2 very exciting, very large copper gold opportunities. And to form a third company would stretch us even more thinly on this. And so I was fully comfortable with the idea of a spinco on this to unlock value on these projects. That made a lot of sense. But I didn't want it to come at the expense of not doing our job well on the 2 big projects we're already working on. So a condition for us to do this is we felt we needed to identify very competent management to take these projects forward. And we were very fortunate that we connected up with Sam Luong, who will be the CEO of Centauri going forward in the motor to drive this. Sam's got great experience. He's a metallurgist by background, worked with Hatch for a long time. So he knows a lot about project development around the world. And then from there, he was a founder in Adventus, which was a very successful venture going forward on that. And more recently was one of the lead directors for Abra Silver and instrumental in getting them onto the Diablios project in northern Argentina. So he knows Argentina well. He knows our space well. He's well known in the markets out there. And more importantly, I feel very comfortable that he has a similar approach to the rest of our team, and his views that doing things the correct way is the best pathway going forward. So I feel very comfortable turning these projects over to him to run. All of us as in Aldebaran shareholders will be shareholders of Centauri, and I'm quite happy that he'll be able to unlock value in the projects we already have there. And I wouldn't be surprised to see if he pulls in some new ones into there as well. Keep in mind that this isn't just a handful of properties with little work on them. Two of the projects are much more advanced than that. The Rio Grande project already has a sizable copper gold resource to it that's very much open and needs more exploration. And the Aguas Calientes project has very good surface indicators, a little bit of drilling already, and is drill ready to go right into it. So it's a great suite of projects to launch a new company with. And Sam and the team he'll build around this will be very good to take these forward. And we'll always be in the background to help on it, but it won't distract us from the job we need to do at Altar.
What are some of the timelines there? When does it list? When does it start doing some work and then communicating with the market?
We're working on all the details on that right now. Our best guidance is in the first half of next year on it. We'll as we get closer to that, we'll be able to announce the time frame on it. It's not imminent. It certainly won't be by the end of the year. It'll be well into next year.
And it's not something that you're seeing as a source of capital, then I assume for Aldebaran. Like it's not like, or would you be there and monetize some of those shares? What would that look like for you?
I think you do what's best interest of all shareholders going forward on this. They're not at a stage that you would particularly monetize them for anything significant. I think it's much better to explore them and make a discovery and add value to them before that happens.
Right.
So we will, and these shares will be they won't be held by Aldebaran. They'll be distributed to all shareholders. So it's not something that we're looking for as a way to finance Aldebaran. It's really trying to unlock value that's there that's not realized by our shareholders now.
What's going on with Regulus? Just one last question here, maybe a brief update on that. I know we'll do another interview and specifically on Regulus sometime soon, I'm hoping, but what's going on there?
A lot behind the scenes as usual. Regulus is the one that we're dying to be able to talk more about what's there, but we're a little bit restricted due to the complexities of the complex land ownership and the more confidential relationship we have with our neighbors and other interested parties nearby. But we're advancing with as I think most people know, we've got to have an agreement to produce a consolidated resource estimate for the district. We own a portion of the deposit, and a joint venture of 3 companies owns the other portion of the deposit next door to us. And we have an agreement to produce a consolidated resource estimate as if there weren't any property boundaries. And that's a lot of the work that we're doing right now. We anticipate that'll be ready by the end of the year. There is an important caveat on it is the agreement we have to do this is under confidentiality. And so when it's done, I will need mutual consent from ourselves and the joint venture next door to be able to present that to interested parties or to present it publicly. And there's no guarantee that we'll have that. So I'm quite confident that they will see the logic in us revealing it to interested parties. There are some valid reasons that they might have to not want to have it out publicly. So it's important that people realize that it will be done, but I won't necessarily be able to talk about it. But it still puts us in a much better position to understand the full value of the project and interact with groups that are interested in acquiring our portion of the project.
John,
So lot happening there. There's also some very interesting developments in terms of Cajamarca in general. There's an interesting parallel between the Department of Cajamarca and the province of San Juan. Both of these areas, in my way of viewing it, have some of the best opportunities to really develop significant copper industries going forward. San Juan and Cajamarca each have several existing mines that are predominantly gold mines, and many of those have reached or are reaching the kind of natural end of their mine lives. And then they have a large number of defined big copper deposits that are ready for development. There are 6 of them in San Juan. There are actually 6 as well in Cajamarca that are ready to go and drawing a lot of interest. And I think both San Juan's clearly embracing this and making things more attractive to be able to go forward. And Cajamarca is realizing that they really would like to continue to have a mining industry and not see the existing mines wind down. And they're going through the process of what do they need to do to make it more attractive to develop the projects there. In Argentina, it was a fix in terms of the investment setting. In Peru, it's really more related to permitting and social situations on the projects. But the government's embracing that and working with all of us that are involved there. So we feel fortunate that both of our companies happen to have assets in 2 hot spots for copper development, where most of the big projects are already held by the majors that are likely to develop it. And if another major wants to enter into either of those 2 areas or to increase their exposure in those areas, we're kind of the clear targets in both cases. So we think we're pretty fortunate that we have great projects, and we have great projects in hotspots that are drawing a lot of attention right now.
Again, hopefully something we can talk about in the near future as well, that being Regulus. You promised me an hour. I've taken almost an hour and a half here. So I'll wrap it up with this last question. I ask it to you, I think, every time we speak, but if you had a magic wand and you could wave it at something and make a challenge or an issue go away, what would you wave it at?
I think in our particular case, what I'd wave it as is companies pulling the trigger on acquisition of major copper projects. And everybody knows that needs to be done, and everybody's kind of watching and looking. And we see this every time we enter into an M&A wave, and I'm old enough to have seen several of these waves now, is that as they start, everybody's a little nervous to do it. Everybody's watching, everybody knows you kind of need to do it. But the first CEO that makes a decision to pay a significant amount of money to acquire a project is sticking their neck out a little bit. Because it's purchasing these things doesn't always work out as well as it should. Usually not because of the project. It's usually the time frame it takes to get it into production afterwards. And so, but what we often see is that there's hesitation, and then one project will be acquired, and then another one will be acquired, and then suddenly it switches, and your shareholders are asking you, why aren't you buying something like your peers are doing? And you get a kind of a fear of missing out mentality on it. And so oftentimes it takes something to get that started. The Filo acquisition by BHP is really the only significant acquisition in our space to date right now, and is a very good one for a lot of reasons on that. But I would really like to see a few more happen. One of the things that we talk about a lot is that one of the best things that could happen to us is that if somebody bought out one of our peers. And that seems a little strange, like, well, somebody else is being picked before you. But what it does is it kind of it increases the atmosphere for people to pay on this. A little bit like, first to be second, as you mentioned before on this. Sometimes the first one goes, and then it gets people to move more quickly and perhaps more generously too. So if I could wave that magic wand, I'd like to see that happen. I've been anticipating it for a number of years now, and we seem to be kind of slow to get to it, but I think we're much closer now.
Thank you so much for this conversation. I'm looking forward to further developments, but I am going to let you go now. And yeah, thank you so much for stopping by today.
Okay, appreciate it. Thanks a lot.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias. Again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. So unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. it is setterplus.ca where you do your research. That's where you'll find a company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."